is the cash flow available to only shareholders. Why is it relevant for us in company valuation? This is very relevant for us in company valuation because free cash flow to the firm are the cash flows we use when we want to evaluate the firm value, whereas free cash flow to equity are the cash flows we will use once we want evaluate the equity, just the equity value of the company. Of course, when we talk about intrinsic valuation, so intrinsic valuation, just to recap, intrinsic valuation, so or as we say, DCF valuation, so discounted cash flow methodology, is a valuation approach where the essential assumption is that markets are not efficient, okay? So markets are not efficient, but at the same time, the market themselves tend to adjust the value of the asset during time. So through discounted cash flow evaluation, through intrinsic valuation, what we will do is to find the value of the asset based on fundamentals. Okay, so we do not trust the market. We do not trust the market price, because otherwise I could say, okay, why should I evaluate where should I find the value of a company, of the equity of the company, if I have the market price? The equity value is simply the market capitalization, price times the number of shares outstanding. So we say price times NOSH, okay, number of shares outstanding. I have it. Why should I go back to fundamentals? Because the assumption is markets are not efficient. So very often we can find the company is overvalued or undervalued by the market because of a series of reasons, okay? But discounted cash flow methodology allows us, even when we find that the market fairly prices the stock, the reason, and we can find the justification to the price. So we go back to fundamentals, we go inside the company. Okay, now, okay, Francesco, you're the last admitted in class today. So we can justify. So which are the ingredients of discounted cash flow methodology? We start from the assumption that by defining the value of the asset through discounted cash flow methodology, stating that the value of any asset is equal to the present value of future expected cash flows, discounted at a rate that reflects the riskiness of cash flows. So which are the ingredients, let's say, of discounted cash flow methodology? First of all, are cash flows, and we know cash flows. Second are the growth rates, because it's the present value of future expected cash flows. So it means that we need to attach to the cash flows a growth rate. We cannot, estimate and calculate the cash flows in details for any item, okay, for each year. But what we need to do is to attach a growth rate, and we will see how to calculate the growth rate. So next week we will exploit, the growth rate. Third is the discount rate. So which is the discount rate? Which is the appropriate discount rate which reflects the riskiness of the cash flows? We will see that in firm valuation, the appropriate discount rate for the company will be the WACC, the weighted average cost of capital. Whereas and we will work on the WACC, in the ingredients of the WACC. Whereas for equity valuation, which will be the appropriate discount rate, it will be the cost of equity, or in other words, the expected return on equity by shareholders. Okay, these are the discount rates for the firm valuation, WACC, and equity valuation, and the cost of equity. Okay. In general, we say that the value of any asset, of an investment, of a strategy, of a plant, property, plant, equipment, whatever, is the sum from, for T, going from 1 to N, of the future expected cash flows. So for some assets, we have a definite life. In the case of company, if I'm working with a company, maybe evaluate a company on an ongoing basis, I cannot say when it is, how much is N. So I'm evaluating, I don't know, TripAdvisors. TripAdvisors, which is the time period I should consider? 5 years, 10 years, 20 years? TripAdvisor is a working company, is alive. I'm not supposing that TripAdvisor would cease its activities in 10 years. So what I need to do, and we will see, is to consider a different, time horizon, which will impact on the growth rate, of course. So in company valuation, time will be, instead of being in this way, so where we have N as a final year, 5 years for the plant. I know that the plant, after 5 years, or 10 years, will need to be changed. Not for a company, unless I'm evaluating a company for liquidation purposes. Do you remember when we said, but the liquidation purposes is, I use an asset valuation. So I simply say that the company is, the cement factory is equal to the value of the grinding mill, of the, I don't know, the kiln, or all the PP&A. In the case of the company, what I need to do you see if I write here down? Okay, thank you. I knew that. Sorry. So this is 0. This is N. And then we have the infinite, okay? So we divide the time horizon, okay, in 2 components. The estimation period, okay, the analytical estimation period, it could be 5 years or maximum 10 years, because I have the ability to estimate a precise growth rate, and then from there to the infinite, okay? MS in finance students already know these methodology, because at least MS in finance students who comes from the University of Siena, and so they took my course of corporate finance, they are supposed to know, when we did equity valuation, the, the 2 stage growth rates, okay? So we have, but we will work again on this, of course, no worries. So we have a detailed estimate, an analytical, let's say, a detailed estimation program, so I say time, and then the rest, okay, from n+1 to infinite, okay? It's like Buzz Lightyear, Buzz Lightyear through the infinite and beyond. You're too young, you do not know Buzz Lightyear. Do you know Buzz Lightyear? Yes, you know, great. 1 point. I like Buzz Lightyear. It's, even if I'm a boomer, I like Buzz Lightyear. Now, okay, we saw it. Saw it. Okay. Saw it. Okay. 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 As I told you before, if you evaluate the entire company, the entire firm valuation, WACC, discount rate, just the equity claim in the company, equity valuation, cost of equity. One of the first principle of valuation indeed is never mix and match cash flows and discount rates, okay? Never discount the free cash flow to equity at the WACC, and never discount the free cash flow to the firm and the cost of equity. Um, Now, which are the steps in discounted cash flow evaluation? So we want to find the value of the company. Which are the steps we need to follow? First of all, is to estimate the discount rate or rates to use in the valuation process. So it could be, as we said, the cost of equity or the cost of capital, the weighted average cost of the WACC, if we evaluate the equity or the firm. It could be in nominal terms or in real terms. And of course, also here, never mix and match. If I have cash flows in nominal terms, I will use discount rate in nominal terms. If I have cash flows in real terms, I will use discount rate in real terms, okay? So never mix and match. This is one of the first principle, the most important principle in valuation. Never mix and match. And the other point is that discount rate can vary across time. So we can decide if we define a discount rate in T0 and we do not change it, or we can make the discount rate changing across time. Give you an example. The weighted average cost of capital, as we will see, is what? Is the weighted average cost, is the average, let's say, of the cost of equity and the cost of debt weighted for the respective, let's say, the part of debt and equity over the total funds of the funds invested in the company. Okay, so when we talk about debt, again, is the only non-operating debt is the financial debt. So everything we did in the restatement of the capital of the balance sheet stands here. Okay, we talk about debt is a financial debt, is an interest-bearing debt, because we will see we attach the cost of debt. So it depends, we could say, it depends on the financial structure of the company. So it depends on the mix between debt and equity. I can assume that the mix of debt and equity could change over time, okay? That the company will start today with the given capital structure, but which is not considered an optimal capital structure, and the company will tend to an optimal capital structure or to a different capital structure. So if I change the capital structure, the WACC could change, okay, for example. So 3 points. So first step is estimating the discount rate. Discount rate can be in real terms and nominal terms. Third, discount rates can change over time or not. Second step, estimate the current earnings and cash flows on the asset to either equity investors, cash flow to equity, so free cash flow to equity, FCFE, or to all claim holders, FCFF, okay, so free cash flow to the firm. So second, estimate the current discount cash flow. Estimate the future earnings and cash flows on the firm being valued generally by estimating the expected growth rate in earnings. So what I need to do is, okay, I have the discount rate, then I have, which is the current cash flow today. So we are evaluating the company today, which is the cash flow we can calculate, is the 2021, assuming that not today, because the income the financial statement of 2021 are not out yet. But assuming they are out yet, I can start with 2021 cash flow. Okay, and I would calculate cash flow. No, as we know. So we take the balance sheet, we take the income statement, we take the balance sheet of 2020, and calculate the cash flow. Perfect. Third step. The second step. Third, estimate the future earnings and cash flows of the firm being valued, generally by estimating the expected growth rate in earnings. And this will be the second step, the third step. So this is the program for our next weeks. So estimate the discount rates. So the first thing we will do is to estimate the discount rate. We will exploit the discount rate. Then we will work on what? We know that we already know this because this is something I started with. Second, what we will do is to estimate the growth rate. So how can we estimate the growth rate? Also, MSc Finance students who worked with the equity valuation, indeed, they do not know how to estimate the growth rate. So they were expected, so they were, used to have the G. Given a G1, a G2, two growth rate, whatever, but they had the G, okay? What we need to do is how can we find the G? So how do analysts estimate the G? This is something which is important. Then estimate when the firm reach stable growth. Exactly, the dotted line, the part of the dotted line. So, and what characteristics, risk and cash flow it will have when it does. So the timeline I designed before, this is essentially here, okay? It's not dotted, but if so this is a period, this is a moment where the last point of the detailed, let's say, analysis is the point where we assume the company that from then the company is in stable growth, okay? So what we need to do is to decide what is the GN. So which will be the growth rate of a company in stable growth. And there is a very simple solution for this. One thing you will learn is that company valuation is a very practical tool. So what we will do very often is, okay, the model, the theory says something, but we need to apply it. And very often, what theory tells us doesn't work for a company, so we need to find a solution. It's a very practical tool. What we will do very often is, and I will say, let's average. We use an average everywhere, okay? Because we do not know. And do you remember, and probably one, if not in the first lesson, in the second one, when I told you the myth in valuation, a complex model, provides a lot of information. No, okay. Very often, once you reach, a certain level of complexity in company valuation, that's all. The marginal, value provided by a further information, a further element of complexity doesn't, add, quality to the valuation process. And then finally, choose the right DCF model for the asset and value it. Now, again, this is the another graph, but I think it is very interesting, you have all the input here, cash flows, okay? So for the firm, free debt, cash flows, so free cash flow to the firm, equity for cash flows, expected growth. So they impact on the numerator, okay, on the future cash flows. Here, the firms reach stable growth. One thing I didn't tell you, okay, sorry. So what we will split, let's say, once we have this time horizon, this timeline, sorry, we will have the value of the company, we will, let's say, composed by two values, two sub-values. So as this value is equal, always present value, future expected cash flows, but analytically will be equal to V1 to N plus terminal value. Sorry. plus the present value, sorry, of terminal value. Ok, vabbè, dillo. The present value of terminal value. Okay, so what we need to do is to calculate this plus the terminal value. And where is the terminal value? Why the present value? Because we need to evaluate everything today. Is when the company reaches the stable growth. Sorry. Now, length of the period, high growth, forever, high growth, analytical growth, whatever. Here, denominator, discount rate, cost of capital, of cost of equity. So have this chart with you and you remember everything. Now, we can have different approaches to, we have essentially three approaches in discount intrinsic valuation. Dividend discount model, DDM, free cash flow to equity, it is potential dividend discount model. So free cash flow to equity and dividend discount model, and FCFA is the equity value and this is fair value, okay? No doubts on the I, because otherwise. So fair value and equity value. So the fair value, we have two approaches, the DDM, this dividend discount model, and the free cash flow to equity model, the free cash flow to the firm for firm valuation. Now, as I'm lazy and I'm so busy today, I want you to work and to tell me, I'm kidding, of course, free cash flow to equity, potential dividend, in parentheses. Why a free cash flow to equity potential dividends? Well, better. I would like you to tell me, which is in your opinion, and it's not just for you, all the online students. I would like you to tell me, with your words, in your opinion, which is the relationship and the difference between dividends and free cash flow to equity. No, well, not exactly, because it's right if you say it is dividend per share, but dividends are dividends. And then also the free cash flow to equity can be on a per share basis. It's simply divide by the NOS. Okay, I need to work. So, okay, you're not supportive. You're not supportive. I don't want to work. I just want to listen to you. But okay, free cash flow to equity. What is free cash flow to equity? It's the cash flow available to shareholders, right? This is how we define it. So it is the cash flow, let's say, it is what it, the correspond, which is the, in terms of earnings, which is the correspondence of free cash flow to equity when we talk about earnings, the net income, right? Net income, free cash flow to equity. What is net income? Is the earnings, which is our residual for residual claimants as shareholders are, right? Earnings are cash flows, not. Our earnings essentially what shareholders can have in their hands now, because we saw that between earnings, so net income and free cash flow to equity, there are many things. Okay, we have investment, we have change in non-cash working capital, we have debt repayments, new debt insurance, we have interest expenses, we have tax shield, we have many things. Okay. So free cash flow to equity is the cash available to shareholders. Available to shareholders. Now, you are investors. You wanted the lottery. You invested part of your money in stocks, which are at the end of the year for each company, okay? And you buy a certain number of shares of 3 companies, let's say. For each company, which is the cash that effectively you can have in your hands at the end of the year in your bank account. Is the free cash flow to equity relative to your shares? No. What is? It's the dividend. Now, when we have net earnings of free cash flow to equity, and the calculation is based on earnings, then we need to have the free cash flow to equity available. That's another story. Do companies pay out all the earnings as dividend? No. So earnings and free cash flow to equity as a cash flow are potential dividends. So in theory, if the company decides to have a dividend payout ratio of 100%, so it pays out all the entire earnings as dividends, your free cash flow to equity and dividends will be the same. But the company very often does not pay out all the earnings and free cash flow as dividends, because we have earnings, part we pay out as dividends, and part we reinvest in the company. In your opinion, and so sorry, the part which is reinvested in the company are called retained earnings, right? So the company will have a payout ratio and a retention ratio, okay, which is the complement to 1 of the payout ratio, or vice versa. So we have that payout ratio is equal to 1 minus retention ratio, or vice versa, retention ratio is equal to 1 minus payout ratio, given 100% part. So that's why free cash flow to equity are potential dividends. They're not necessarily dividends. Very often, but free cash flow to equity are higher than dividends. But indeed, dividends is the only cash that in practice, in reality, goes in the bank account, in the hands of shareholders, okay? That's why we also have the dividend discount model. So which are the ingredients? Cash flows. So we have different approaches, same ingredients, but with different, nuances. So we have, for the dividend discount model, which is the cash flow, we consider as a numerator dividends. For the free cash flow to equity, free cash flow to for the potential dividend approach, free cash flow to equity. For the firm valuation, free cash flow to the firm. Expected growth, which will be the expected growth that we need to calculate, the third step. Equity income and dividends. So we need to calculate and attach the expected growth in equity income, so in net income and dividends. In equity income and free cash flow to equity for the FC equity valuation in free cash flow to equity. And for the free cash flow to the firm, this is less immediate, probably. Which is the growth rate we need to calculate? So which kind of earnings we need to attach a growth rate in high growth or in stable growth to operating income, okay? Because do you remember when I told you, let's pretend we are sitting on the operating income and look down. What is the operating income provides us? Which is the information? Is the income available to the claim holders of the company, okay? And the same is free cash flow to the firm. So everything depends on the operating income. So, which will be the cost, the discount rate, cost of equity and cost of equity for equity valuation, either in the case of DDM or free cash flow to equity, cost of capital in the case of free cash flow to the firm. How can we define in theory, because again, this is a problem in practice, when the company reaches the steady state? We can say that, of course, it is sort of implicit when dividends will grow at a constant rate, or when free cash flow will grow at a constant rate forever, in both cases, or when free cash flow to the firm will grow at a constant rate forever. Here is the assumption we need to do with work it. So let's start easy, and let's start with the dividend discount model. Okay. Now, um, which is the, how do I calculate the dividends? Dividends are equal to net income times the payout ratio. Okay, which is the payout ratio? The payout ratio is the ratio of income that the company decides to pay out as dividend. Simply this one. So if I have a net income of 1 million and my payout ratio is 30%, how much will be dividends? 300K. The rest will be retained and reinvested in the company. If I work on a per share basis, I can say that dividend per share is equal to D, where D is the payout ratio, is the letter with which we use to indicate the payout ratio, times EPS. Okay, so you won the lottery, you decided to invest in 1,000 shares of TripAdvisor, you will have 1,000 and the DPS of TripAdvisor for 2021 will be $2 per share. Your dividend income will be $2,000. Okay, so dividend per share means which is the share of dividends for each stock of the company. And dividend per share is simply, like earnings per share, it's simply, we find simply dividing earnings per share, earnings, net income, dividing the number of shares outstanding. Okay? So net income, payout ratio, dividends, we can use the per share basis or total company, okay, on the total basis, not on a per share basis. Now, which is the growth rate? This is a G. Which are the inputs we need to consider when we talk about the G in dividends? Okay, I can say that the expected dividends, this is a starting point. The current dividend, which is the current dividend in 2021 of TripAdvisor, is X per share. Which is the expected dividends? The expected dividends will be the expected net income, the growth rate in net income, which when we have the expected here, is that we need to consider the growth rate in net income, times 1 minus retention ratio, or times D. Why in this case, and we can say that D is equal to 1 minus B, where B is the retention ratio, okay? No dots on the EI, otherwise. Okay, B is the retention ratio. Let's use this letter, okay, so you become familiar with these letters. D, small, is not capital letter, D D capital letter is debt. D non-capital letter is payout ratio. Payout ratio, as I said, is 1 minus retention ratio. Okay? Because 100% income, net income, part will be paid out as dividend, part will be retained. Why do I work here? Not with the assumption need to be made, not with the dividends, but the payout ratio, but with the retention ratio. This is a subtle distinctions, subtle difference. You say, okay, you work with the retention ratio, it's 1 minus retention ratio is D, it's the same thing. Nope, it is not the same thing. Or you could say, yes, but I could say, you know, I work directly with dividend, with payout. Nope. And the reason is here. Retention ratio needed to sustain growth. And let me, you know, exit from the box for a while. But not because we think out of the box, but simply because I need to borrow some notions from outside. Let's go back to, do you remember which is one of the motto of our class? You can forget the details, but do not miss the storyline. Okay, do not miss the storyline. There is a storyline we need to follow. And during this course, I will give you a series of dots, and we need to connect. Sometimes we need to go far and connect. At the moment, we do not go too far because we have, you know, our past and our relationship between me and you is not so long. But let's go back to the restatement of balance sheet. Invested capital plus non-operating assets equal total funds invested in the company, right? Debt, financial debt, interest-bearing debt, risk-bearing capital, where it is equity. We are working on a book value of equity, right? If I exploit the book value of equity, which are the items I find in the book value of equity? Do you remember, I do not reopen the slides. And the book value of equity, and a given balance sheet, which are the items I find? What do I have? The capital invested by shareholders, you know, in book value. Exactly. We have retained earnings. So we have net income, which is necessary to balance the two things, and we have retained earnings. Now, how do we call debt, financial debt, and equity? For total funds invested in the company. So these total funds can come from outside the company, from financial markets, but also from inside the company. So when the company decides to self-finance, use self-financing, internal financing, sorry, not self-financing, it is the translation of the Italian, internal financing. How does the company internally finance itself? Through retained earnings. Now, why should a company, in your opinion, and I can leave the floor open, the floor is yours, why should a company prefer to use internal financing and not going to outside financing? So debt, no debt, or issuing no shares. First of all, of course, it depends. Could you please speak, because with the mask, I don't know. The difference? Okay, you say, I do not pay interest rates. So it is Is this free? Are you MS in finance or finance? Congratulations. Is equity free for the company? It's a free source of financing?
It depends on the location of the company. Not all company can go to bank.
Okay, I might have some, difficulties in, having new debt. And what's your name? I do not remember. Filippo says bigger companies, as more, let's say, an easier access to the banking market, right? And it's true, there are also all the problem with the relationship between bank and companies, of course, the small companies, SMEs, and so forth. Yeah, it's true. But there is also another point. Why younger companies and growing companies, for example, need to use more internal financing than mature companies in mature sectors? There is one small word you always need to take into account. 4 letters. Exactly. It is risk. So it depends on also, of course, what you said was correct, but also depends on the riskiness of the company and on the assets. Why? As we will see, what is the cost of debt for the company, the interest rate for the company? If we look at the other side of the coin, so if we were the head of the bank, of the bondholders, which is for the same number, 5%, is the interest rate for the company, and what is for the bondholder, for the bank? Is the return, right? For me, I need to pay, and he needs to receive. Now, if the investment is risky, and the company is assumed to be risky, what will happen to the cost of debt? For the interest rate, or we're the head of the banker. You're giving me money, I ask you to give me money. I'm a risky company. What will you do? He said, okay, I give you money, but high rate of return. So the cost will be higher, This doesn't mean that equity is free for the company. Equity has a cost, which is the expected return, but we will work on this. The expected return to equity. Now, in order to sustain growth, the first source of growth is internal finance. That's why we need to with the retention ratio and not with dividends. Okay. Of course, indirectly we work with not with the payout. Sorry. Of course, indirectly we work with the payout, but the approach is let's work on the retention ratio, which is the amount of income, well, the portion of income I need to retain to sustain growth. And we will see that the higher is the retention ratio, the higher will be the growth rates. MS in Finance students are supposed to already know this. And I invite MS in Finance students to, have a look of the undergrad program on this, just to help me in doing the lesson about growth rates, okay? Because I'm lazy and I want you to work. So what we have is once we have the 2 ingredients, the length of the high growth period, and we calculate the present value of the future expected dividends, calculated in the expected dividends. Then we have a stable, using the cost of equity, okay, discounting as the cost of equity, which is the cost of equity. And it is the return rate which is required by equity investors in the company. And we will work on this tomorrow. Then we define the stable growth, and we have the terminal value, and we calculate the present value of the terminal value, and we put everything, we evaluate the company today. Now, potential dividends is the same thing, but which is the difference? Here we have the free cash flow to equity. Free cash flow to equity equal to non-cash net income less capex less depreciation less change in non-cash working capital less parentheses debt repaid less debt issued. Or what we can say is less capex plus depreciation less change in non-cash working capital less debt repayments plus new debt issuance, free cash flow to equity. Again, it's the expected growth in net income, equity reinvestment needed to sustain growth. What we will have is expected free cash flow to equity is expected net income 1 minus equity reinvestment rate and cost of equity. The same thing as the high growth and terminal value cost of equity as the denominator. Entire business, what changes? Free cash flow to the firm. Free cash flow to the firm after tax, NOPLAT, okay, plus depreciation, less capex, less change in non-cash working capital, free cash flow to the firm. One thing here, how we calculated the free cash flow to equity was from free cash flow to the firm to free cash flow to equity, starting from NOPLAT. And what we did between free cash flow to the firm and free cash flow to equity, less interest expenses, less debt repayment, plus debt, new debt, plus a tax shield. Do you remember the 5 between 4, how much was? Okay. I can also directly start with net income. Okay, if I want to calculate free cash flow to equity, I start with net income, not passing through the NOPLAT and the free cash flow to the firm. If I start with net income, I do not have to consider interest expenses because I already have a net income. I do not have to consider the tax shield because taxes are paid on taxable income. So sorry, because net income is net of taxes, and net of taxes paid on taxable income, and taxable income also included the tax shield or interest expenses. So what I have to do is just to consider the balance sheet change, the change in the items of balance sheet. So those, let's say, activities put in place by the company during the year which had a financial implications, but I do not see in the balance sheet. Okay, this is the second way to calculate the free cash flow to equity. So free cash flow to equity could be NOPLAT plus depreciation, less capex, less change in non-cash working capital, free cash flow to the firm, less interest expenses, less debt repayment, plus new debt, plus tax shield, free cash flow to equity. Alternatively, net income, which already included everything, plus debt repayment, less debt repayments, plus new debt, less capex, plus depreciation, less change in non-cash working capital. Okay, so we split the two parts just to. Okay, at 5 minutes. So we have here expected growth with a G. Expected growth in sorry. Here, sorry, I was back to the. Need to go back to the free cash flow to the firm. So free cash flow to the firm of pro forma valuation, growth. Expected growth in operating income. Okay, expected growth in operating income. So to estimate it, we need to consider what? Not the retention ratio, but we will work with the reinvestment rate. It is called differently. It's how much of the operating income I do reinvest in the company. And so I will have the expected free cash flow to the firm will be equal to expected operating income 1 minus reinvestment rate, okay, which is not the retention ratio. We will call reinvestment rate, usually we use RR, reinvestment rate. So again, the same for the growth, discount rate, the WACC, weighted average cost of capital. So weighted average cost of equity and debt. Okay, so see you tomorrow. Thank you very much, and sorry for the shorter class and the shorter notice. And remember, no class on Monday.
Bye. Professor.
Bye-bye.
Bye.
Thank you, guys.
Bye.
Bye-bye.